Focusing on Europe once again, the ECB doling out easy money to the banks to keep the credit markets open. Now more than $630 billion has been awarded in low-cost loans. That is far more than analysts estimated. And for more, we're joined by RDQ Economics co-founder and chief economist John Ryding. John, great to have you on In the Loop. Markets don't seem particularly excited about this announcement, even though the size of it is so much bigger than anticipated.
Well, I don't think we can judge the success or failure of an operation by what happens in the first couple of hours of trading after it's announced. Look, let's look at what the ECB did. Despite their reluctance towards doing some form of quantitative easing, they put almost 490 billion euros for the next 3 years into the European banking system. So look at what they're doing, not what they're saying, and they've done more in this operation than people expected. So the ECB is clearly signaling its willingness to expand the size of its balance sheet and to support the markets. Now the question is, what do the banks do with this money? Is it just to replace borrowings they have to pay back next year because there's a lot of bank debt coming up, or will some banks go out and put the carry trade on and expand their exposure to European sovereigns? Because you can take debt, 3-year debt, say Portugal, at 17% and borrow 1% from the ECB and book that 16% for the next 3 years. That's a very compelling profit opportunity if Portugal isn't going to default on its debt.
Well, that's a big if, right? I mean, we're not talking about Portugal so much these days, but it wasn't long ago that seemed like a big if for Greece. So what do you think the banks should do with the money? I mean, many are going to be forced to recapitalize. We know that. Can they afford to go out and actually invest?
Well, remember that the bizarre rules, capital rules for Basel make all of these European government bonds 0% risk weighted. So there's no capital charge under the current Basel rules for banks to go out and buy European debt. So one way to recapitalize is through earning money. So if the European enterprise is going to hold together, another big if, but I expect that they will muddle through somehow. There's a compelling recapitalization opportunity here. And I think some banks will go out and increase borrowing. And the problem is in Europe, as to some degree with the US bank regulators and the Federal Reserve, people need to get on the same page of the playbook. We need this government debt to be held. We need yields to come down. And the banks are the biggest buyers of the debt. So if the bank regulators then turn around and say, well, you've got to reduce your exposure to the sovereigns, they're only compounding the problem. So I expect some of it will find its way through the back door into the European sovereign debt market.
You bring up the U.S. and what we're doing here with our banks. Yesterday, the Fed made a big announcement, but it seemed as if it was lacking some critical details. What are they waiting for?
Well, it's lacking all the details. I mean, this is really a document to seek comment over the next 3 months from the banks. But what it really is a continuation of what I think has been a very poorly constructed exercise, which is Dodd-Frank. And I don't think that Dodd-Frank gets to the heart of creating the incentives for the banks to operate safely and profitably, and is very much about compiling and compounding lots of regulations on the banks, like the Volcker rule, which hurts banks' profitability. It wasn't really a factor. Prop trading was not a factor in the financial crisis in 2008.
John, unfortunately, we have to leave it there. We got to go to break. I would love to spend more time with you getting your insights. Thank you so much for joining us on In the Loop. That was John Ryding of RDQ Economics. He's co-founder and chief executive.